If you have ₦1,000,000 today, which will you invest in? Will it be stocks or Forex markets? Now, today we'll say the difference between the stock market and the Forex market or Forex trading. They are both financial markets, but there's a very key difference between the both of them. And most people are very confused on how do they participate in the stock market or how do they invest in the Forex market. Welcome to Clockwise. My name is Providence and my guest is here to do a critical analysis of these two different markets, the stock market and the Forex market. So if you have money, which should you invest first? Which has a better investment returns on investment? Is it the stock market or the Forex market? Welcome to Clockwise and welcome, Mr. Kande.
Thank you very much. Thank you.
You see, we've had these questions over time, and people will be saying, is it the Forex market that is faster or is it the stock market that is faster? And most people don't even understand the difference between Forex, trading in the Forex market, and also investing in the stock market. They are two different things. But before we look at the differences, let's first of all look at the similarities. Are there similarities between the stock market and the Forex market?
Yes, there are similarities between the stock market and the Forex market. So, to put it in proper perspective, the Forex market and the stock market, all of them come together to form what we call the financial market.
Okay.
So in the Forex market, both of them actually can be traded on online platforms. So online platforms can afford you the opportunity of investing in the stock market. You can also trade financial instruments like the Forex.
Okay.
Both of them need technical analysis. Both the Forex market and the stock market, they need technical analysis. Both of them react to news. Okay. Yeah. For example, and policy. So, for example, if the government, if like we saw what happened with during the Iran, Operation Epic Fury, most of the things, any announcement that comes, in fact, as simple as President Donald Trump posting on Truth Social would affect both the Forex market and the stock market. So both of them react to news. Then both of them also react to government decisions. For example, when the Fed does anything, maybe the Fed lowers or does anything with the interest rate, with the federal funds rate, any rate decision that is made, even the comment that is made, the post decision conference handled by the Fed chair affects both markets. So they both work based on news. They both work by what we call demand and supply.
Okay.
So they just the same way the Forex market relies on demand. More demand pushes price up. Same thing with stocks.
Okay.
So both of them actually work. If there's a market crash, it affects both of them
at the same time.
Yes. So the way it affects is a bit contrarian. For instance, let us say for a particular pay, let me give you an example. If the US market slumps, what happens is that equities, that is stocks, could go down. But what you see happen is that the dollar will go up. Okay. Because think about it, investors are rotating from stocks to USD. So USD quoted pays would be green.
Oh, that's a good one for the Forex market.
Yes. So when you say good one for the Forex market, it depends on which side you are.
Okay.
If you are in a long position for USD quoted pays, then you would say it's a good one. Because what tends to happen, for example, when in reaction to the inflation, that when CPI went as high as 9.1%, what happened? The Fed started slamming the brakes on its easing cycle, started raising interest rates aggressively.
Okay.
So what happened is that, of course, that is negative for stocks, equities. Investors rotated from equity into the Forex, the USD. That's why you saw the USD kept on.
Okay. Now that we've established similarities between them, let's look at the difference. The major difference between the Forex market and the stock market.
Okay. So there's a difference, very clear difference. For example, I had said the Forex market is you are trading currencies. Yeah, you are trading currencies, you are buying one, and they're usually quoted.
Let's make it practical.
So, for example, Euro USD, you are buying, if you are, for a pay quoted as Euro USD, what that means is that if you are longing the market, if you are buying into that position, what you are basically doing, you are buying the US dollar and no, sorry, buying the euro as a currency, and then you are selling the US dollar. So what that means is you benefit when the value of the euro increases, relative to the dollar. So essentially, at the very basic level, that means you are believing that European economy will perform better than the US economy.
So you're buying their currencies.
That's why you're buying. When investors buy into a currency, they're actually buying into the faith. The faith in that particular economy. Okay. So that's what you're doing. So you can buy and then you can do what? Sell. So you have to do both at the same time, actually. You do both at the same time. You buy some instruments and then you sell some. And one of the pays, the euro in that pay, that quoted pay. You buy it, then you sell the USD. Okay. Then the opposite is the case. If you are selling that position, if you are opening a short position on a euro USD pay, you are literally selling the euro now, and then you are buying the US dollar. So what that means is that as the market moves down, that means the currency, the USD is strengthening. So that's why the market will push down. As it pushes down, you are making money. Okay. So it depends on which side that you are. Okay. You are on.
That's for.
But
for
yes, for stocks, you actually don't do that. When you buy a stock, you actually are buying into the share of a company.
A part of a company.
A part of a company. Tiny part of a company. Okay. Meaning that if that company grows, maybe the valuation of that company increases, then you make money from there. So that is why, and then you can also, in a leverage setting, sell. Like I said, with currency pairs, you can open a short position using leverage. And as the market goes down, you are making money. In a stock market, if you want to you can actually open a short position. You are literally not like buying. Sometimes you sell contracts, you sell options. Do you understand? So it's not exactly like this one, because when you buy, you are literally buying tiny pieces of a company. But when you are selling, you are literally selling either options, or you are selling on leverage. So as the stock of that company goes down, you can buy back and make your profit. That is what we call options trading. But I don't want to go so much into that. But I just wanted to tell you how you can use the same idea of short selling in Forex to put into the stock market.
Okay, so what you're basically saying is that in Forex, you are trying to trade currencies of an economy, of two different economies. Then stock market, you are buying into a business.
Yeah, you're buying into a business.
So when you look at that, which one has a higher risk?
Of course, it's Forex by a long shot. Because let me give you an example. I bought a particular stock 3 years ago. Yeah, 3 years ago. That stock went from $90 to $4. I just sat on it. I left it. I just left it to go to zero. Because the downside risk was already way smaller than the upside returns. As I speak with you, that stock is $186 now. So that can only happen in the stock market.
So you cannot have such scenario in the Forex.
No, in the Forex market, because it's a leverage position. Once you would have been liquidated.
Your stop loss.
If you had put stop loss, but that would have actually liquidated your position.
So
most likely,
there's no potential for comeback.
When you say it depends on your position sizing.
Okay.
It depends on your position sizing. There's a higher risk of liquidation in the Forex market than in the stock market. The stock market, you can only be liquidated if it was a margin loan that you used to buy the stock. For example, if I borrowed $100,000 to buy a particular stock, and then I bought the stock, then the stock goes down. If the stock goes down to a certain point, I could be liquidated. Let's say the value, or once it gets to every lender has where they will get a margin call. They have where you are completely liquidated, depending on the loan to value that you're looking at. If you place a collateral, let's say I place a collateral of $500,000 as stock, and then I borrowed 200,000. You know what that means? Or 250,000. That means my loan to value is 50%.
Yeah.
Good. If I buy a stock and that stock does 50%, in fact, it wouldn't even get up to 50%. Let's say it does about 45% or thereabout, then I would receive, in fact, from 40%, I will receive a margin call. Then maybe 45% I will be liquidated from that position. So that is the only time or scenario that you are going to be liquidated when it comes to stocks. But when it comes to Forex, because of the way the market is also very volatile in Forex compared to stock, so you can easily be liquidated, out of your position, especially if you did not put a stop loss. Even when you put a stop loss, if there's a very serious high impact news, sometimes it might not trigger your stop loss. And sometimes you might even have a negative balance on your trading account.
Now, let's see how you make profit from these two different markets. Let's see how you make profits from the stock market when you invest, because every investor want to make profit.
Yes.
Everybody want to make dividends. So how do you make profit from your investments relative to how you make profits from Forex? Now, the factors that really affects them to trigger profits.
Okay, so if you are talking about factors that affect both markets, for stocks,
trigger profits.
Okay, for profit. So for stocks, for example, you had last week was the earnings call for 4 of the Mark 7 companies. So what happened to Alphabet? Alphabet was through the roof, printed a new all-time high because of, investors were happy with what they had. I was on the call too. Whereas Meta actually had a slump, 9.75%, because investors were not happy. Those are momentary reactions to the market. As a matter of fact, I actually scooped up more Meta on that weakness because the fundamentals are still strong. So essentially, the performance of a particular company determines the price of the stock.
Okay.
That's number one. The Forex market, essentially, what determines the movement of the market would be things like inflation, like interest rates. If the Fed comes up now and says, at this point we are on a pause, but if something happens, the Fed says, okay, we think inflation is sticky, we are not able to anchor it around the 2% target, then they decide to hike interest rate again. What that means is that the Forex market will, dollar quoted pays, all will be highly impacted. So the interest rate decision, especially from the Fed, is very, very predominant in factors that affect the Forex market. So what that means is, how do you make money from this market? Basically, for stock, you make money from two things. Number one, capital appreciation or valuation of the company, return on equity, and then dividend. So let's say I invested in the last couple of episodes, you talked about the fact that you bought MTN at 170, and now it's about 900 or something. Yes. What does that mean?
That's capital appreciation.
That's capital appreciation.
And they're still paying
more than literally 4x.
Yes.
And then that's one. Then the second, you've gotten a dividend, about 16 naira. If you started doing the IPO in December of 2021, you've gotten about 16 naira. If you multiply by the number of shares, you know how much. And then if you also had the 20 for 1, 1 for every 20 shares, that's still another appreciation. So that's how you can make money in the stock market. Capital return on equity, as well as return on as well as dividends. But for the Forex market, you make money based off of the position you are. If you are in a long position, the Forex market goes up, then you make money. Then if you are in a short position, the market goes down, then you make money.
Now, which one is, let's talk about the predictability of these two markets. Which is more predictable? Which can you actually say, okay, if I invest this money, you are accurately sure that by so time you make some.
There is nothing like accurately sure in the financial markets. Nothing is guaranteed in the financial markets, no matter how much you think you know the market.
But I feel the stock market is more structured.
The stock market is more structured because it's regulated by exchanges. Forex market, for the most part, and this would interest some people to know that most of the brokers have what we call dealing decks. So you are actually not participating in the Forex market. You are just literally trading with someone else.
So you're not.
Unfortunately, sometimes you're even trading against a broker. And it's a reality. There's something we call simulated markets. So you can be thinking, even if you have a live account, you might be trading in the simulated market. So you are literally not exposed to the live market. And that provides room for manipulation. So most of the forex brokers are not regulated. That's just a reality. They are not regulated. And so they have a lot of dealing desk. That's why I can tell you categorically that more than 85% of forex traders don't make money. They don't. Stock market gives you a second chance. Forex, your money can disappear instantly. And it can't come back again. Because for the most part, you trade forex with leverage. If I have, let me tell you what you should know. Standard lot, that's 1.0 is $100,000. How many people have $100,000 to put in the market?
So those who are trading below 100,000, what are they doing? They're playing. People
that are trading, if you are trading with $1,000 and you are opening a standard lot, you are actually doing 100 to 100x leverage. So that's the point. So you are doing, if you are using $1,000 to trade, you are doing a 100x leverage. And leverage is a double-edged sword.
Can go anywhere.
As much as it can help you to make more money, it can also wipe your account instantly.
I've had that experience before.
So you realize that in the forex market, the risk of capital loss is very high, way higher. Compare that to the stock market. Like I just told you, something went high, came down to as much as $4.
Went up again.
I just sat on it because there was something I saw. In one part, I was thinking, if it goes to zero, let it go to zero. But something happened. There was a turnaround. The company was actually affected by the COVID-19 thing. So, but it came around, and then I'm up again. That kind of second chance does not exist in the forex market. Once you are liquidated, your position is gone.
You're gone.
Gone. That's number one. Number two, sometimes we rely on stops. There's something we call guaranteed stops, and that is mostly available for institutional investors, institutional traders. Guaranteed stop means that the broker is, and you pay more, pay well. It means that the broker guarantees that your position has to be stopped out at a particular price point. If you are in the market, the FX market, it even happens to indices like NASDAQ, like US, Dow Jones Industrial Average, like S&P 500. But if you are in the market during a very volatile period, during volatility, high volatility, the liquidity is low. Because it's skewed either to so much to one side that some orders are not filled. The market just pushes up because leaving out some orders. So what that means is that remember, if you are in a long position, you put your stop. What that means, if the price comes down and then hits your stop converts into a short position. Now you are believing that the market will actually fill that order. It's an order. It's a stop order. During highly volatile periods, the market might not fill that order. So you know what that means? It means it will wipe down to your liquidation point. So that's why you cannot so forex market is actually something that I don't advise for beginners. I advise if you are experienced, you can go in. You start with with stock markets first. Okay. The only challenge that people have with stock market is, so people come in with $10, just want to fund $10 and trade. You will not make so much in the stock market because, for example, that $10, let me use $1,000 for instance. $1,000 you invest in the stock market. Let's say in a year the company doubles. You just made $1,000, Abi. Good. If you use the same thing in the forex market and then do a 100x leverage, for instance, you are literally trading with $100,000. And if the market does as much as just 10%, you know what that means. So you can literally cash in $10,000 within maybe a few days or a month. Whereas the other guy with same $1,000 is only able to make $1,000 after. So people feel the stock market doesn't move, doesn't give you as much profit. But also know that it's a double-edged sword. So you, as a beginner, you want to test the waters. Start first with the stock. You can delve a little bit into indices like ETFs, like S&P 500 and indices, NASDAQ and all of that. Start with that first. Then from there, you can now move to CFDs. CFDs are actually leverage plays now. But when you're starting CFD, start with something that like the S&P 500. You know why I'm saying that? Because the move is not as explosive. And then you also have to manage risk. I can't say it enough.
Yeah, risk management.
Manage your risk. You know, don't go on Instagram. And I have a lot of people that tell me, I saw one trader on Instagram. The guy has been flipping accounts. In fact, I work in an organization where if you show up, because sometimes we recruit traders, people to join the organization, and it's a very rigorous exercise. You see people that will show up with double, I flipped my account in 1 month. You are not going anywhere. We'll not even reach back to you to talk more of even having a conversation with you. You don't want to follow those Instagram guys that talk about flipping. That's extreme risk. It's not proper risk management at all, and nobody will take you seriously. Rather, you want to, I had told you the last time I was on this show, some time ago, I don't, in our entire organizational portfolio, the maximum we expose to the FX market is 5% of the whole portfolio. Within that 5%, just watch this. The maximum we expose to a particular position is 0.5%. So 0.5% of 5. Because risk management is number one
when it comes to
as an institutional trader or an institutional investor. You know, you must understand that risk. Like Warren Buffett would say, if you are not making money, don't lose money. So capital preservation is number one
in the market.
You can tell your investors, remember, even if you are running a fund, and I'm speaking to those people that are trying to build, even if you are running a fund, there's something called hurdle rate. So for example, if someone invests $100,000 and then you and then you lose $20,000, guess what? You're not going to make a single, and then the next year you make $20,000, you're not getting anything in performance fee because the hurdle rate is $100,000. And you have spent an entire year building back what you lost carelessly. So that's why that's why for us, our drawdown limit on the fund is 5%.
Okay. That
is across board, whether it is stocks, whether it is FX, every single thing that we trade, 5%.
Yeah, risk management is very, very sure. Very, very key. It's key to as far as the financial market is concerned. Now, let me speak to you as someone that just a normal Nigerian guy. Let's say, for instance, you have $1 million naira. And you're in between these two things, because we are still going to re-emphasize this. Most people don't understand the difference. Most people come to the stock market with the Forex mindset. They just come there and they want magic. They want things to just work. But you don't know you're actually investing in people's business, and their processes, their procedures before growth can be established as far as the business is concerned. So now let's look at you being a normal Nigerian guy with $1 million naira. Where will you invest? Is it stock or Forex? And if it is stock, what will you invest in?
I will invest definitely in the stock market.
Okay.
I will invest in the stock market. I will not. Forex is technical. It's for people that are experienced. I've said that again and again. Stock market is for wealth building.
For long-term.
For long-term wealth building. Not the Forex market. So what I'll invest there, and how am I going to invest? I'll invest in ETFs. Okay. I'll invest in stocks. I'll look out for stocks that have not performed well. Like I told you, I scooped up some Meta. I'll look out for stocks that have not performed well. over the past, maybe, I mean, this is earnings season. So a lot of companies are coming up with their earnings call. Like I told you, Access Bank. Access Bank is now trading at what? 0.36 price to book.
That's below. That's even.
That's undervalued. That's like paying investors paying 13 naira for a bank that is valued at literally 18 naira. So that's undervalued, but the fundamentals are still strong. So I will go, So I will go and buy such names on those weaknesses. Of course, we know why they had such. You must have seen the earnings call last Friday. So that is what I would go to buy. I would look at some of those names. You've hear what happened to UBA. So some of those names that have been, we have what we call the foggers. I will look out for some of those foggers that have experience of weakness. You look at the likes of, for comparison, GT Bank is 1.2 price to book. 1.2 times price to book. That is overvalued, really. Access Bank, with very strong fundamentals, 52 trillion in total assets. And I mean, I believe there's going to be a very serious turnaround. And by the way, if you look at the chart, it just broke out. It's been consolidating for a long time. And you know, when the breakouts like that happen, speaking technically, a lot of people sell into that breakout. So, you know, so I would go, I would buy that, and then I would buy some names, some names. I had talked to you guys about the fact that some consumer staples will do well this year. So I will look at some of those names that have high prospects, and I'll dump that $1 million. But I will not dump everything. If I have only, let's say I have only $1 million, I will not dump everything. I will not dump everything at the same time. I always do dollar cost averaging. So if you have an investment app, you put in that $1 million, 1 million naira, sorry, and then you can automate the investment. Every week, every month, push, let's say you can say push 50,000 and invest across these names. That allows you to smooth out your entry. Dollar cost averaging is the best thing since sliced bread. So that is what I'm going to do with that 1 million. So, and thankfully, we have done a video on how you can set up set up an account on an investment platform. So you put in the 1 million naira. When you put in the 1 million naira, there is a way you can automate those investments. Pick some of those names. I'm not making any recommendation in terms of, but I'm just telling you some of names I'm considering because of the weaknesses we have seen. So you pick some of those names. You can, you can do your own research actually and get some of those names and then automate those investments. But the reason why I also said also do ETFs and some index funds is because you want stability in your portfolio. While some of these names might still have some further downside, but the ETFs and some of the defensives, if you want to go into defensives, will help to stabilize the portfolio.
Okay, I think that's a very nice point for you to leave it here.
Yes.
Yeah. I don't know if you actually followed us to this point. You could see the difference between Forex and the stock market, and why you can actually prefer it. For me, I prefer the stock markets to the Forex market. I've done the both of them. I know you also done the both of them.
Definitely.
I always tell you, you see, you cannot predict. Even if you cannot predict the financial market, at least there's a structure in the stock market. You know, you are buying into a business. Okay, this is Dangote Salt, this is Dangote Sugar, this is Dangote Refinery, this is First Bank, this is Zenith Bank. You can see this business, not like the Forex markets. We're not condemning the Forex market, but it's good for those who are technical enough, those who have had experience enough in the financial market before they do. You don't just come to the financial market as a newbie with just some few money or some amount of money, and you want to start with the Forex market. No, start from the stock market, learn the ropes, understand the analysis, the technical analysis. From there, you can actually make investments. And if you find a need to actually pivot to Forex market, fine. You're a master. Thank you for being with us to this point. And at this point, we come to the end of today's episode of Clockwise. Do not forget to like, subscribe, and put on the notification bell on this channel because we bring amazing value every time. And also, do not forget that the elite of the 21st century are not those who did not go to school or those who will not go to school, but are those who have refused to evolve as their environment is evolving. My name is Providence. I'll see you again.